In the next of the series of videos, we look at ways that directors can mitigate their risk. The first one is that they need to understand the activities of the business, so they need to be reasonably informed. They need to understand in the Companies Act what is codified there as behaviours that are needed of directors, and also the recommendations of King 4, which are not necessarily codified unless you're a listed company, but are recommendations on how to behave as a director. If a director is ever sued, there's something called the business judgment rule, which they can rely on to mitigate their risk, to show that they've acted in accordance with the Companies Act or King 4. The business judgment rule basically says that a director must take steps to be informed of the activities of the business and to stay informed. There should be no personal interests or no conflict of interest in any decision. There needs to be a rational basis for any decision that has been made, and it needs to be properly minuted. If this all happens, it gives the director some kind of defense if they are ever sued. As long as they've made decisions in the best interest of the company with all the information at hand, their chances of success are great, but they can still be sued. If the Memorandum of Incorporation allows for directors to be indemnified, they can then take out directors' and officers' liability insurance. What this does is assists the directors, should they be sued, for legal costs to defend it, and potentially also the damages that may need to be paid thereafter. It's a specialist area of insurance with lots of exclusions and endorsements that could potentially be enacted. So it's something that really companies should look to specialist brokers to provide.